Hey, what's up, my friend? So, welcome to today's video, right? The reason why I decided to do this video is because recently on Facebook, I saw someone posting, right? How do you guys go about, finding new trading strategies, new trading setup? And I thought that instead of asking that question, a better way to think about it is that how do you guys find an edge in the markets? I think because after all, right, you need an edge in the markets to be a consistently profitable trader in the long run, right? Without an edge, you won't be profitable, right? Traders can argue, right? Risk management, psychology, right? That's all you need. But if you think about this, right? You can go down to any casino with the best psychology, the best risk management. In the long run, you're still going to lose money to the casino. Why? Because you don't have an edge over the casino. You don't have an edge over the house. So this is important, right? You need to know where your edge lies as a trader. And in today's video, I'm going to explain to you on how we can go about, finding your edge. So all this and more in today's video. I'll see you there. Okay, so to find an edge in the markets, you must first understand that trading is a zero-sum game. So what exactly is a zero-sum game, right? I think most of you probably know by now that it's basically that for every winner, right, you need to have a loser, right? Because the loser will compensate the winner, right? So this is what it means by trading is a zero-sum game. For every winner, there has to be a loser. In fact, trading is actually a negative sum game when you take into account transaction cost, the spread. But let's assume that in a world without transaction cost, it's actually a zero-sum game. So once you understand, right, this fundamental concept that trading is a zero-sum game, then you can actually have the answer into finding an edge in markets. Because this foundational principle over here already gives you a big clue on how to go about finding an edge. Right? Basically, an edge is something that, if you do it repeatedly over time, right, it's going to yield you a positive expectancy. It's going to make you money in the long run. So this means that if you want to be a winner in the long run, you have to take advantage of the loser. So this brings us to the question in your trading, which is, at which point of the chart will you know that you can profit from a losing trader, right? Or rather, at which point on the chart a trader is going to get trapped so that you can actually profit from his losses, right? This is it, right? If you can answer that question, then you have found an edge in the markets. So let me share with you two examples, all right? Breakout and reversal. So what is breakout and reversal? So just imagine this, right? This is a range, right? Say this is resistance, this is support. And let's say at this point in time, the market, say for example, is going up and down, then it trades up and breaks out. So at this point in time, when the market breaks out of the high, there are a few traders who will take different actions. Number one is what I call the breakout traders, right? They'll go long on the breakout of the highs. Okay? So where would they put their stop loss, right? You can guess that chances are their stop loss will be in the middle of the range or maybe at the opposite end of the range, right? And then what happens next is the market starts to dip lower and comes back into the range. And at this point in time, what's going to happen is that there will be this second group of trader, let's call them the reversal trader, right? What are they going to do? Well, they're going to go short at resistance, right? Because they know that the market has failed to break out. So this is what's going to happen, right? So at this point in time, the second group of traders is short the market. And this first group of traders, the breakout traders, are long the market. And imagine what happens if the market dips lower and lower. What's happening now? Well, clearly, this group of traders, the first group, the breakout traders, are in the red, right? Negative sign. Because they go long above the highs and now the market has dipped lower. Whereas the traders who traded the reversal, now they're in the money because they sold at the highs and the market is trading lower right now. Okay, so you can see what's happening is that there is a transfer of so-called money in this particular trading scenario. Breakout traders are feeling the pinch, and reversal traders, they are in profits, right? So basically, at this point, reversal traders are profiting from the breakout traders. And let's assume the market goes lower, right, and it starts to consolidate near the lows of support. So this group of traders, the reversal traders, they exit their trade, right? Because, okay, maybe They have, make their money, right? They have, capture one swing, they exit their trades. So breakout traders at this point in time, chances are they also, stopped out of their trades already, unless they are the stubborn ones who refuse to cut their trades. Okay, so now the market starts to consolidate at the lows of support, and then it breaks lower. Breakout traders, they see this breakout. So what they do? They go short, right? They went short over here. And at the same time, this group of reversal traders, they see initially price was at support, and they decide, okay, maybe it's time to go long and to, see if the market can goes back up towards this high of the range. So breakout traders, they go short. Okay? And reversal traders now this time around, they go long. So by this time around, the breakout is real, right? It starts trading lower and lower. So what's happening now? Well, clearly, breakout traders, they are in profit, right? Let's give them a positive sign. And reversal traders, they're in a negative, because the market didn't go higher. Instead, it starts going lower, right? Those conservative ones who use a stop loss, they will be stopped out of their trades. But those stubborn ones who does not trade with a stop loss, this group of reversal traders are seeing their losses snowball bigger and bigger. So where are all these losses going to? Well, all these losses are going to the breakout traders, right, who shorted the breakdown. So can you see right now, using these two examples, you've actually understood why trading is a zero-sum game. Because for a trader to profit, someone has to lose, right? There is no way that both can win at the same time, unless you're dealing with the stock market because of payment of dividends. But we are not dealing with stock markets, we are dealing with the forex and futures market. So this is why you need to understand that whenever you put on a trade, you have to understand who is the one on the opposite end of your trade. And at which point will they start to feel the pain? Because once you can identify their pain point, right, that is where the profit opportunity lies for you. So now you may be thinking, okay, Rainer, apparently, both breakout and reversal, they both can make money. And yes, it's true, right? There are traders who trade breakouts and are successful with it, and there are traders who trade reversals and are also equally successful with it. There is no right or wrong down here. But what's important is to understand that not all breakouts or reversals are created equal. You know that they are basically on the opposite end of the spectrum of one another, right? Breakout profit from reversal traders profit from breakout traders. But the thing to understand is that not all breakout and reversal are created equal. So this means that you need to find a filter, alright, or rather to quantify specific trading situations where it is more favorable to trade breakouts or when it's more favorable to trade reversals. So once you can actually quantify this particular market scenario, you're very much closer to finding your edge in the markets. Okay? So just walk you through an example. So this is the chart. Doesn't really matter what chart this is, right? So you can see that it's actually the Pound Aussie daily for those of you who are wondering. At this point, right, this is a black line over here. So you can see that this point, market is making higher highs and higher lows. And when the market trades above this high over here, you can be sure there will be traders looking to go long on a breakout. Why? Well, you have a series of higher highs, higher lows, alright? Price breaks out the high, trend is likely to continue, I go long. And where will they put their stop loss? Chances are they'll put their stop loss perhaps below this low or this low over here. Well, this is pretty much, how traders would put their stop loss. Unlikely to put below this low because it's almost like 1,200, 1,300, 1,400 pips, right? It's too large, right? A retail trader won't have a 1,400 pip stop loss, right? Usually, it's more likely to be somewhere below this low or this low, right? So they go long on this breakout over here, right? Thinking price would trade higher and possibly retest this highs over here. And what happened next? Well, the market did trade above the high only to close much lower, right? You can call this perhaps an engulfing pattern or reversal candlestick pattern, whatever it is. But clearly you can see that the breakout didn't go higher. So at this point in time, the traders who long the breakout are trapped, right? You go long at this high and the market has closed lower. What's happening to your position? You're in the red, right? You're in the red. Breakout traders, they are in the red. Negative sign. What about reversal traders? Those traders who saw this reversal pattern, right? They noticed the price didn't trade higher. They decided to go short. Right? So they go short, and as price goes down lower, right? They are in the money, right? They're in the green, right? They're in the green. Right? And as the market goes lower and lower, you know that this is likely where the breakout traders place their stop loss below this low or this cluster of support over here, right? This swing low over here, right? So when these stops get triggered, what happens? It fuel further price decline. So the breakout traders, if they take the loss, good, right? They cut their losses and move on. But reversal traders, right? As the market goes lower and lower, right, it becomes more and more profitable for them. And there will be this small group of traders, I don't know how small they are, but there will be this group of traders, the breakout traders, who refuse to cut their loss. Right? They just don't want to cut their loss. Right? They think that the market can't go any lower. Right? This is what multi-year low. The market can't go any lower. Right? So they hold on to the losses, and the losses get bigger and bigger. Right? Whereas the reversal traders, their profits get larger and larger. So you can see a transfer of money in their account from the breakout to the reversal traders. Okay, so this is an example, right? Again, more this time around is using a real chart to share with you, right, how reversal traders can profit from breakout traders, and breakout traders can profit from reversal traders. But we won't go into the breakout profiting from reversal traders because you probably get the concept by now already. All right, so yeah, so my point is this, right? Is that whenever you put on a trade, right, it's really important to understand who you're profiting from. This is why I'm always very wary of traders, right? Saying that they are using these indicators. The indicator cross up, that one cross down. It's a buy signal. They go long. It doesn't make sense to me because do you have any idea who you're profiting from? Right? Just because your indicator point up, point down, whatever, it gives a buy signal. But looking at the fundamental picture, the most core basic principle where trading is a zero-sum game, who is on the opposite end of the spectrum on that particular trade of yours? The only traders who you're going to profit from if you're using indicators is the same group of traders using that same core set of indicators and then taking the opposite action of you. Alright? That's the only way you're going to profit from them, if the market goes in your favor based on that set of whatever indicators you're using. So, I'm not saying that indicators are wrong, but what I'm saying is that it is a wrong way to approach trading if you're just, splashing indicators on your chart, right? Hoping that, a few of them will give you a buy signal, right? All point in the same direction as a buy signal, but really, it doesn't make sense. Okay? Instead, learn to see the charts. Ask yourself, right, where traders are trapped. Where are they likely to put their stop loss? Where will they feel the pain? Once you can identify where this group of traders will feel their pain, and then you can actually profit from them, right, when the trade goes against them. Alright? So just to recap, right, trading is basically a zero-sum game, right? For every winner, there has to be a loser. You need to know who you are profiting from, right? Reversal traders are profiting from the breakout traders, and breakout traders are profiting from the reversal traders, right? The reason why they both can be consistently profitable traders in the long run is because not all breakouts and reversals are created equal. So this is why you as a trader need to filter out particular market scenarios where it favors to trade the reversals or where it favors to trade the breakout. Okay? So I've come to the end of today's video. Alright, not sure why that slide popped up, but yeah, I've come to the end of today's video. I hope it really gives you an insight into how to find an edge in the markets. Okay? I gotta admit it's not easy, but I believe I've given you a core set. A core trading concept, right? To actually go about looking for an edge, right? Let's put it this way, right? In trading, there are only a few ways you can enter the markets. You're either going to enter on a breakout, the reversal, or another subset of reversal is a pullback. Right? There's only a few ways you can enter the markets. Alright? And there is no right or wrong to each approach. I think what is more important is to understand which method suits you, and then to understand, right, who are the traders on the opposite side of your trade. Where will they feel the pain? And once you can actually define it, right, this is where you could possibly find an edge in the markets. Alright, so with that, I've come to the end of today's video, right? I hope it makes sense to you. And if you enjoyed it, right, feel free to hit the subscribe button below. And I'll talk to you soon. With that, wish you all good luck and good trading, and talk to you soon.